banking just gets more and more competitive. Nowadays, banks have to worry not only about competition from foreign banks opening branches in this country, but insurance companies and stock companies and mutual funds are now offering services that substitute for the services offered by banks. Therefore, to stay in business, banks are always looking for ways to increase their revenue, expand their customer base, and shrink their costs. One of the big costs associated with banking is the cost of holding reserves. Bank reserves include cash held in the vault and money on deposit at the Federal Reserve System. These reserves earn zero interest, and the bank would rather take this money and lend it out to some business that would pay interest rather than hold it as reserves. Banks hold reserves, however, because it's necessary to have a certain amount of cash on hand, just in case people want to take a lot out of their checking accounts on a particular day. However, the Federal Reserve System requires banks, by law, to hold 10 cents in reserves for every $1 that the bank has offered in checking accounts. It's a legal requirement. So, we might ask ourselves, what is this law accomplishing? Can we not rely on the free market to give us the right amount of reserves? Don't banks best know how much to hold in reserves to do their business well? Or do we really need a law? Consider the question, are reserve requirements necessary? Are they accomplishing something for the economy? Let's think about this question from two perspectives. The first perspective concerns risk. The reason banks hold reserves is in case synchronization fails. Synchronization means that on a given day, people are depositing about as much money as they're withdrawing. Therefore, the bank doesn't have to hold a lot in reserves. It can take the money that you've deposited and give it to me when I come in to make a withdrawal. This allows the bank to devote the bulk of its funds to long-term investments that pay high rates of interest. However, if on a particular day, maybe due to a big shopping sale or something like that, a bunch of people come in to make withdrawals from the bank has to scramble to come up with cash that hasn't been deposited that day. That means going down to the vault and taking out the reserves. Well, if it doesn't have the reserves, the bank finds itself in trouble. And the Federal Reserve System wants to make sure that banks, as a rule, don't get in this position very often. Why? Because when one bank finds itself having to shut its doors, saying that it can't meet the demand for liquidity on that particular day, customers of all the other banks in town get scared that maybe their bank is in the same position. Next thing you know, the whole banking system, which depends on the depositor's confidence, is under siege. We've got a systemic problem. This is a kind of like, you can decide if you want to smoke or not, whether you want to put your own lungs at risk, but if you smoke in a crowded room, you're making a choice that puts other people at risk as well. And this is a reason why there may be a law that prohibits it. So the reserve requirement is a kind of law that keeps banks from taking risks that might impose costs on other banks. However, in some ways, there's no need to be quite as scared about this as we might once have been. That's because banks can get money pretty quickly if they need it. A bank that is solvent, that has enough assets to back its liabilities, can always get cash for the short term by borrowing from another bank, or even in an extreme case, borrowing from the Fed itself. So, all we have to be worried about is whether the bank is solvent or not. And the bank is typically going to be solvent because the managers of the bank have put enough of their own capital at stake that they're going to make sure the bank is well managed and not taking extraordinary risks that could jeopardize the solvency of the bank. So, if banks can borrow money anytime they run into a short-run failure of synchronization, a liquidity crunch, then maybe the reserve requirement is not so necessary after all. The second perspective from which to think about this is the concern about the stability of monetary policy. What the Federal Reserve wants to do is to create a steady demand for reserves so that it can provide more reserves when it wants to allow banks to make more loans and increase the money supply, and provide fewer reserves when it wants to put banks in the position of having to call in loans and shrink the money supply. By creating a mandatory reserve requirement, the Fed creates a stable demand for reserves, which allows it then to manipulate the money supply with some regularity and security. If we allow banks to decide how much they want to hold reserves for themselves, they're going to hold the amount of reserves that minimizes the risk of not having money to give your depositors when they come in to take out of their checking accounts. Now, the amount of money that banks have to hold as a cushion is going to depend on the way in which deposits and withdrawals are timed. At a particular time of the year, when there's a lot of shopping being done, there may be a lot more withdrawals than there are deposits. At other times of the year, there might be a lot of deposits and fewer withdrawals. And sometimes there are surprising events like a crop failure or the closing of a factory or a special unannounced sale that suddenly change the demand for money. And if the demand for money changes unpredictably, the banks may have to very quickly try to adjust their holding of reserves to avoid a liquidity crisis. Well, if we're letting the banks do all of this based on their own best judgment, then what the Fed is going to say is, we don't know how much reserves banks want to hold. The demand for reserves is going to vary one week to the next, and that makes it harder for us to maintain a stable interest rate, that is, to supply the amount of money that meets the demand for money. Well, is this a big problem? Can the Fed be flexible enough? Can banks be flexible enough? We can look at the example from some other economies, the United Kingdom, Canada, and New Zealand, all three of which have no legal reserve requirement on banks. And yet, they have a banking system that is as safe as the banking system in the United States, and their monetary policy has been conducted with relative stability. That is, it doesn't seem to have been a huge problem for the central bank of those countries to provide money to meet the increased demand and to bring the money back in when demand goes slack. So it just requires a little bit more flexibility. Sure, a reserve requirement creates a steady demand for reserves, but if the central bank is flexible, it can provide extra money when demand is up and pull it back out of the economy when demand goes down. So it's an interesting question. We can't say for sure one side or the other, but as a rule, it's generally good to let the market solve problems rather than law, as a rule, unless you can make a compelling argument for why the law is necessary, either to control events that impose risks on others or things like that. Then let the market make the decision. Let the banks and the other actors in the financial system decide what's the right amount of reserves for a good bank to hold to do its business well. On the other hand, still concerns about the systemic nature of risk in the banking system and fears about policy being conducted in an orderly and reliable way mean that reserve requirements will probably persist for a while longer.